Hi, everybody. We'd like to welcome you to the beginning of a new video series we like to call In the Heat of Real Estate with the Heeter Home Team. Fatima and I, your buyer specialist on the Heeter Home Team, are here to help you with everything real estate. And joining us today is our guest, Corey Bowman, a loan officer at HarborOne Mortgage. He's going to be going into detail with pre-qualification, pre-approvals, interest rates, loan programs, and of course, answering all your questions that you may have. Hello, Corey.
Hey guys, thanks for having me.
Thanks for joining. As always, please, for everyone watching, make sure to open up the chat box on Zoom or use the comment section if you're watching on Facebook to ask any questions. We'll be looking at that periodically to just see if you have any and answer them along the way. But throughout the webinar, we'll be going over our most frequently asked questions when it comes to pre-approval, interest rates, and loan programs that are out there for you. So Marie and Corey, take it on.
Yeah. So as a lot of you may know from our past webinars, we do stress this topic a lot. So the first step to the home buying process should be getting a pre-qualification or a pre-approval. So Corey, what's the difference between the two? What's a pre-qualification and what's a pre-approval?
Very good question. And a lot of people don't know that there is a difference between those two. Ultimately, it's telling you the same exact thing in the end, you know, how much you qualified for and is this loan going to work? So a pre-qualification basically is I'm asking everybody for their particular documents, you know, like their pay stubs, W-2s, tax returns. We pull your credit report and then we run it through an electronic underwriting system. And what that spits, it's going to spit back some information with us if you're approved or not. And if it comes back approved, then we can go ahead and get a pre-qualification letter issued to the borrower to work with their realtor to start shopping for a home. Now, the pre-approval, very similar, we're doing the same things, but the main difference is we are sending all of that information to the underwriting department for a full review of the file. Now, that typically happens after you put a home under agreement, then it goes to the underwriting department to be reviewed. So this is happening beforehand. Sometimes when we do this, it might be, you know, maybe we're not entirely sure if this is going to work and we just want to send it in to be sure, or we can do it as a particular benefit to the borrower. So when they're, you know, are shopping around for a home, if you're pre-approved versus pre-qualified, it's a little more leverage when you're trying to make an offer. You can let the, you know, the seller and the listing agent know that, hey, my borrower is pre-approved. This is already done to the underwriting department. So this guy is a shoo-in, guaranteed to get the loan. So sometimes that could be a benefit to the borrower up front.
Do you always suggest to go for the pre-approval?
Not always, because, you know, some loans are pretty cut and dry. You know it's going to work based on the information that we've received. So sometimes we don't always do that because, you know, you do have to send it into the underwriting department, and then it could, you know, you're waiting a few more extra days to get that response back. So if we don't need to do it, typically we don't, but if it's asked for, and, you know, if we're going into competitive offers and we know that, we can most certainly do that for them.
Okay. Now, when it comes to banks versus brokers, does a person have to apply with the bank that they usually bank at, or do they have options?
No, absolutely not. You know, they're free to choose whoever they want. So the main difference between, you know, a bank and, let's say, a mortgage broker, a bank or a mortgage lender, they're the ones that are lending the money. The mortgage broker is kind of like the middleman. They're not lending any money on this. So what they're going to be doing is you're going to apply with them, and then they're going to try to find a lender for you that fits your scenario. So sometimes you might see people using a mortgage broker. Let's say they have a really weird scenario where, you know, maybe not a lot of banks and lenders can do the loan. So they'll do the legwork for you and try to find a place that will fit for you.
Okay.
Yeah. And oftentimes too, banks, you know, they have their full line of mortgage products, but a mortgage lender, like HarborOne, oftentimes they'll have even more products available for the borrower to work with. So that's one of the benefits of working with a mortgage lender versus a bank. You might have more products and more availability to do different types of loans.
Okay.
Yep.
So yeah, Marie, did you want to continue on with the next question?
Yeah. So this is a big one. I mean, this is probably the most common asked question. What do you need as a loan officer from the buyer to complete a pre-qualification? I know you just kind of mentioned a few things, but if you could go into a little bit of depth with that.
Yeah, sure. So main things we're going to need are copies of your driver's licenses, your most recent 30 days of consecutive pay stubs, your most recent 2 years of W-2s, and your most recent 2 years of federal tax returns. Sometimes we'll ask for bank statements too, depending on certain programs like to look at bank statements in more detail. So if I know we're trying to fit somebody in a particular loan, then I might ask for those up front too. But typically I'm not asking for the bank statements up front to do the pre-qualification, and just those other documents would be needed.
Okay.
Yeah,
Do they typically? Oh, go ahead.
Yep, and then they could just be, they don't have, we don't need the originals either. They could just scan and email them over. That's typically the most common form of way for us to get that documentation.
Awesome. Do they typically look at how long you've been with an employer?
They do, yeah. So you can be, it actually comes down to how long have you been in this line of work? So you could have just been with an employer 2 months ago and then you switched to a new job. It doesn't mean that's not going to work. We're just looking to make sure that you have 2 years experience in that same field line of work. That's kind of what we're looking at. So that is a very good, that's a big one that comes up sometimes. So it's a good question. So yeah, 2 years is the magic number for that.
What do loan officers look at when it comes to credit scores? How does getting pre-qualified kind of work into that, and how does it affect your credit?
Sure. So the minimum credit score requirements for most loan programs is a 620. So as long as you're above that, you're going to meet the minimum score requirement. Some programs will require a higher score than that, but the bare minimum right now for us is a 620. Now, obviously, having a better credit score increases your chances of not only getting the loan approved, but it's also tied into interest rates too, which we can go over in a little bit, because having a better credit score often translates to a better interest rate for the loan. But yeah, so we always pull your credit report up front, so we're going to know all this information. And even if you're not there, let's say you're like a 600 or something, we're still going to help you and work with you along the way to get you to where you need to be. So just don't feel like we're going to leave you out in the cold and be like, yeah, come back when you're at that score. We can help you and try to give you some advice to try to get those scores up. So that's definitely something.
So even if people are looking maybe 2 years ahead of time, you can sit down with them and tell them, what they need to do to kind of work up to the price range that they want.
Exactly. Like, and for instance, like last year we had a borrower that was, I think their score was like a 570 or something. And I sat down, I worked with them to be like, all right, let's work on getting A, B, and C done. And then within 6 months to a year, I think you're probably going to be ready. And guess what? They did exactly what I asked them to do. And then within a year of that happening, they bought their first home. So
awesome.
Yeah, we do that all the time.
Are there any types of first-time homebuyer courses or programs that people can go through to learn how to, up their credit or pay down debt?
Yeah, in fact, there's a popular one that a lot of people choose. It's called the New Hampshire Housing Finance Authority. So they have a website. If you go to that website, if you just Google that, their website will pop up. But there's a first-time home buyer kind of like seminar that you could take. It's all online. It kind of goes through the ins and outs of buying your first home. And that's pretty informative. Some people will do that on their own just to, get a good crash course on what it's like. And sometimes they'll go through that program to get a loan, and that's actually a requirement. They'll have to take that online course.
Oh, wow.
Print off the certificate at the end. But it is very informative. It's not a bad thing to do if you are buying your first home, because not only am I going to be informing you, but this will it might give you some other things that maybe I might not touch on. So
yeah.
Good idea. Yeah.
So when it comes to pre-qualifications and pre-approvals, does that affect your credit score at all?
Yeah. So and that's a question that often comes up. So when I pull your credit report, it's going to show as a hard inquiry to your credit report. You don't obviously want too many of those, but what they're really looking for is one hard inquiry. It's not going to really affect your score much at all. But what it does affect your score is, let's say you go out and go shopping for a car. Then you're going to go out and apply for some credit cards and maybe a personal loan. And now, I'm also going to go buy a house too. So those are all inquiries coming in at the same time, and it kind of looks like you're on like a shopping spree, so to speak. And that is what's going to drop your score. All those inquiries coming from different areas, you know, in a short amount of time, that will actually drop your score quite a bit. So you don't want too many of that. But one or two here and there, especially if it's in the same thing. So sometimes people will shop for a home and they'll be like, all right, I'm going to check with a couple different lenders. And then each lender will pull their credit report. It's in the same field. So the credit scoring model knows what they're doing. So it's not like they're on a shopping spree. It's normal to kind of do that. Same with the car. You might have a couple different inquiries for buying a car. That's okay. It's not going to really drop your score that much.
Is there a certain time that they can do that? I've heard 6-month time frame where they can, shop for mortgages.
Yeah, it's generally a couple months like that. Yep, and that's normal.
All right, so we always suggest that a buyer get a pre-qual, even if they're just looking online. Make sure you know how much you can afford before you start really searching and looking at houses. What really often happens is that people don't get their pre-qualification, don't get their pre-approval. They don't know how much they can afford, and they start looking at houses that are in a higher price range that they can afford, or that they can't afford. And they get disappointed. So we really want to avoid that. So get your pre-qual, get your pre-approval. Do not forget that. That's the important part.
Very important.
So now very. We'd like to talk a little bit more about interest rates. We were talking a little bit about credit scores. So how does a credit score impact a buyer's interest rate?
Yeah, so obviously kind of like how I touched on before, the lower, this is a general rule of thumb, the lower your score, the higher rate's going to be. So it's imperative that you try to get your scores as high as possible, because having a better interest rate is going to it's going to equate to a cheaper monthly payment, and it's going to give you more buying power because of that, and less interest paid over the life of the loan. So someone that has a 620 score versus a 700, it's going to be a big variance in what that rate's going to look like. So I always try to tell everybody, if you can at least get your scores up above 700, that's going to kind of give you that better rate range that you're going to get. And not only is that going to translate into a better rate, but if you don't have 20% to put down on the loan, you're going to have PMI too. And if it's on a conventional loan, and if you have like a lower credit score, that could be quite high. So, and we can touch on the PMI in a little bit as well. But credit scores are huge, and definitely can affect your buying power and what your interest rate's going to be. So very important to have those scores where they need to be. And like I said, we can kind of counsel you a little bit too. If you're not quite there, we can tell you, like, let's focus on A, B, and C, and we can try to get you up here. So when you are ready, hopefully you'll get that good rate that you want.
Awesome. And what is today's kind of current average interest rate? Because I keep hearing that it's really low right now.
Yeah, and there's several different programs out there with different interest rate models, but generally they've been around still the low 3s, and that's on a 30-year. Yeah, that's on a 30-year mortgage, so it's still really low. This is the perfect time to buy right now if you can, just because taking advantage of that rate. I mean, that's a no-brainer.
I know.
It's awesome. They're great.
That kind of leads into the next question. How does the current rate right now affect a buyer's buying power? If you have a lower score, does that affect how much you can afford in the long run?
It does, yeah. So that's going to give you, if you have a lower score, it's going to make your monthly payment higher, which means that's going to affect how much you can afford, because we're going to be looking at things, it's your debt to income ratio. So we're going to look at what your monthly income is, what you have for debt, and then see what you have left over for that mortgage payment. And with that higher interest rate, that means you're going to have a higher payment, which translates to that price range that you're going to be in will go down because of that. So definitely having a lower rate will benefit you in the long run for sure. Yep.
So if you have a really good credit score, you can get a lower interest rate. And so that basically that's less money going to interest. That's more money that you're pre-approved or pre-qualified for to spend on a house.
Exactly. Yeah. And it's very interesting to see too. There's documents that we can print out to show the borrower, if this is your interest rate, let's say it's 4% and you could potentially get 3%, seeing how much the interest you're going to pay over the life of the loan for each of those scenarios you'll see what the savings is. I mean, it's huge. So having that better interest rate is going to be huge in the long run. I mean, the amount of savings on that interest alone, it's good. It's crazy to see what those differences are just because of the rate.
Yeah.
Yeah.
So what's the difference between, because we hear fixed rate, variable rate. So what's the difference there for somebody who may not know?
Yeah. So fixed rate, most people want that because what your monthly payment's going to be month to month. It's not going to change. The only thing that could possibly change with a fixed rate is typically people will escrow their monthly taxes and their homeowner's insurance into that payment. So if those go up, which sometimes they do, that's the only time your payment would change, is if one of those two things went up. But your mortgage itself, that principal and interest payment, will not change. Adjustable rate mortgages, however, will typically be fixed for a couple years. It could be 1 year, it could be 10 years. And then after that fixed period is done, then your rate is potentially going to fluctuate. And 9 times out of 10, it's going to go up. So, people are like, well, why would I even want that? Generally, sometimes those adjustable rate mortgages will offer you a lower interest rate up front, which could be attractive to some borrowers, and that's why they'll sometimes do it. Or maybe they know that they're not going to be in the home for a long time, so maybe they know they're going to sell it within that period before that rate adjusts, and sometimes that would make sense for them too, and that's why they may choose one of those types of loans.
Okay. So going off of that, what's the difference between an interest rate and an annual interest rate?
Very good question. That's like one of the most confusing things out there that people wonder. So the interest rate, that's the rate that's going to determine what your monthly mortgage payment is going to be. And the annual interest rate, the APR, so that's the rate that's going to, it basically tells you the total cost of the loan. So what that's doing is it's incorporating what the interest rate is, along with the costs, like the closing costs that are involved, and it puts that information together as a rate, so you can see what the total cost is. And it's a very good tool. Like if you're shopping around at different lenders, the higher the APR would typically mean the higher the closing costs. So it's a good way to compare if you are shopping around, the APR to see really what's the true cost of the loan, and that's what that is. It's incorporating all the closing costs of the loan into a rate.
Right, so pay attention to that.
Yeah, good shopping tool. But the APR, that does not determine your monthly mortgage payment. That just tells you the total cost. The interest rate is what determines the actual payments.
Okay. And people hear in the past your points, a buyer's points or discount points. So how does that kind of fit into everything? Does that lower the interest rate, or what does that do?
Yep. No, another good question. So sometimes we typically will give someone an interest rate, and it's called what they call the par rate. So there's no points involved with that, but you have the option of paying a discount point, and what that's going to do is lower your interest rate. So let's say the rate right now is 3%, and you're like, wow, I really want a 2.5% rate. Like, what can you do? So we will look at our pricing engine. We're going to see what the cost is to get to that 2.5% rate, and that translates to discount points. So we will let you know, all right, if you want a 2.5% rate, this is how much it's going to cost you. And you don't pay for it up front. It's kind of included in your total closing cost. So yeah, so when you come to closing, that's all incorporated into that amount. So when you bring that one check to closing, that would be part of that. And some people choose to do that, if they definitely want that, much lower rate. It does happen. So, but yeah, that's
Is it something that you'd really recommend, or it's kind of just
it depends.
Yeah,
I guess it all depends on how much the cost is. You got to look at that. If it's like $10,000 to get it down to 0.5%, is it really worth it? You got to look at that thing. But sometimes it is worth it, depending on how much the cost is. So we can definitely look at that if someone wants to potentially buy down the rate.
Okay.
Yep.
Awesome. So we've gone over a little bit about pre-qualification, interest rates, but let's go over some loan programs that are available. So Corey, how do you as a loan officer or just a loan officer assess what loan program would be best for a buyer?
Yeah, and that's the toughest part of our job, I guess. So once we get all of the borrower's information, pay stubs or W-2s or tax returns, and we plug it all into our system here, and we get their credit report pulled. So we're going to look at, what's their debt to income ratios look like? How much cash do they have available to spend? What are their credit scores like? Some programs are a little more lenient than others as far as like if you have a lower credit score, maybe this type of program would be better because the cost would be less. And if you don't have as much cash to bring to closing, some are better than others because you might be able to get a lower down payment, or there might be some down payment assistance available for other programs as well. So we look at the total picture. How much cash do you have available? What are your credit scores like? What are your debt to income ratios? And we'll see what program kind of matches you best based on your particular scenario, and then go from there. But usually we'll break it down as, all right, you qualify for this, but you can also get this. Which one sounds better to you? Sometimes it's not always cut and dry. Sometimes there could be some that are both good, and we'll present those scenarios to the borrower to let them pick. All right, I like this one better. This is kind of what I want to use. It's a good question.
What are some of the most common loan types that people get in New Hampshire, at least?
Yep, most common ones are conventional loans. Those are probably the most common ones that you'll see. And then aside from that, you'll see government programs like FHA and VA loans, and also USDA loans. And that kind of leads to what are the differences, and it usually comes down to the down payment requirements and things like that. Yep. But I'd say conventional tends to be the most common one.
Most common, okay.
Yeah.
Is there a certain advantage of a conventional versus others?
Well, most people tend to strive to get into a conventional first if they can, for a couple reasons. If you don't have 20% to put down, you're going to have PMI. And on a conventional loan, you will have the PMI, but it will go away on its, eventually on its own. Whereas a government program, it might not, depending on how much cash you have to put down. So that's one of the things that people look at, do I want PMI for the life of the loan or for a certain amount of time, or a conventional, eventually go away. Yeah, so that's one of the big things. And another thing is, sometimes when you're putting in an offer on a home, oftentimes from what you guys have probably seen it too, if someone has a conventional loan, when they're putting in an offer over like a government loan, sometimes we've been seeing the seller picking the conventional over the government loans because in their mind, they think the government loans are a little more picky, with the property. If there's anything wrong with it, the conventional might be a little more lenient on certain things. And sometimes they'll tend to lean towards the conventional. So I usually try to get everybody into that one first, if possible. But if not, it's not the end of the world because there's other great programs out there for them that would help them buy the house.
Nice. So what are some of the requirements needed for, say, an FHA loan?
Yep. So like FHA is very common loan, and credit score requirements. 620 is going to be your minimum score requirement, and they're also going to require a 3.5% down payment.
Okay.
Yep. So that's those are the two of the biggest things, and you're going to have monthly mortgage insurance with that. So that's your PMI that we talk about, and it's 0.85% of the amount that you borrow. So sometimes, let's say I'm trying to get you into a conventional loan, but you have a lower credit score. Well, your monthly PMI might be way higher on that than it would the FHA loan. So we might try to get you into the FHA at that point because it's going to be cheaper overall and make more sense for you. So again, that comes down to, once we look at all your information, what program makes the most amount of sense. So we might say an FHA loan makes more sense over conventional for you because it's going to be this much cheaper. So we look at all of those things.
Oh, okay. Do you have to be a first-time home buyer to qualify for FHA?
You don't? No. Nope. Anybody could use an FHA loan to buy. So yeah, you could have owned 10 homes prior to that, and now you could still use it again. Now there could be things where, let's say you already own a home and you used an FHA loan to buy it, and now you want to buy another home. That could turn into a problem because you can't. Oftentimes you can't have more than 2 FHA loans out at once.
Okay.
There are some situations where you can, but oftentimes it doesn't end up working out. So,
Are the requirements about the same for a VA besides for, needing to be a veteran or having been in the services? Are the requirements about the same?
Yeah, credit score wise, they are. But one of the nice things about the VA loan is it's probably the best loan you can get out there. I mean, if you served your country and you're a veteran, you get rewarded here when you're trying to buy a home and use a VA loan. Number one, because it's a zero down loan, so you can't beat that.
That's awesome.
So zero down. And on top of that, they don't have any. There's no PMI. So
Wow.
one of the nice benefits of the VA loan program.
Goes straight to equity.
Yeah, and and they have great interest rates too. So if you're a veteran, I always you got to take advantage of that program. It's the best one out there for sure.
Are there any specific requirements for the USDA that you mentioned?
Same credit score, usually 620. But USDA is obviously, you have to buy in a more rural area. So that's where the big difference is going to come down to, is where you can buy. So you can't buy in, let's say you're in Manchester or Nashua or Concord. You're not going to be able to buy in those cities. But a lot of the surrounding towns probably would qualify. Typically, it's population is 20,000 or less. But if someone ever was wondering, all right, does this town qualify? Just let us know. We could look it up for you to make sure. But a lot of the small towns do qualify for that. And one of the other things that they look at for USDA too is you can't make too much money. Not a bad thing if you make a lot of money, but USDA has what they call county loan limits. So we'd have to look at what your total household income is and make sure it doesn't go over those particular income limits. So, and it varies by county. So we could look up, depending on where you're looking to buy, and see, all right, the cap is $100,000. As a household, you guys can't make more than that. So we would look at all of those things. If someone did want to buy it, use a USDA loan to buy their home, make sure that they fall under that requirement as well.
Okay.
But it is a great loan program if you can get into it, because still good interest rates, low monthly PMI.
Mm-hmm. We keep mentioning PMI. What is PMI specifically?
Yep. So it's an amount that you're paying because you're not putting 20% down. It's kind of like insurance to the lender in case you default on the mortgage. So the more money you put down, like if we're looking at a conventional loan as an example, the minimum requirement to put down is 5% typically, and you're going to have PMI. But let's say you have 10% to put down. The amount of that PMI will be less. It goes in kind of tiers. So, and then if you put down 15%, then it's going to be even lower. So the more money you put down, if it's less than 20%, the lower your PMI could potentially be. And then with government loans, as an example, FHA, if you don't put at least 10% down, that monthly PMI will be with you for the life of the loan, unless you refinance later down the line into like a conventional loan or something like that. And then the other loan programs are typically with you for the life of the loan too. So it's one thing to look at, but it's not a death sentence. Even if you get an FHA loan and put 3.5% down, which is the minimum, yeah, you're going to have PMI, but who's to say that, down the road you can't refinance, into a conventional loan? And oftentimes I will try to help people do that to eventually get rid of that monthly amount.
Now, I know that you had said that's like with a VA, there's no down payment or anything, but within the other loan types, are there any programs that can assist with down payments?
Yes, there are. And in New Hampshire, there's an agency called New Hampshire Housing Finance Authority. We work with them all the time, and we can use conventional loans and government loans with them. But as an example, oftentimes people will do an FHA loan, which is 3.5% down. And you can get cash assistance from them to help with that down payment. So you can get either 2% or 3%, and that's of the amount that you borrow to help with that down payment. And if you do a USDA loan too, which is a zero down program, you can go through them as well and get cash assistance. And what that cash assistance would be to help pay the closing costs of the loan.
Oh, nice.
So,
okay.
yeah, so you can potentially buy a house with very little money out of pocket. So some people, you know, in their mind thinking, you know, I want to buy a house, but I don't have a lot of money, you know, talk to me, because we can, there's a program out there for almost everyone, depending on what your situation's like, especially with the, you know, agencies like New Hampshire Housing that can help with the cash assistance and the down payment to get you into a home, you know, with not a lot of money. So it's yeah, that was a good question.
Are those the grants that everyone's talking about?
Yep.
Okay, awesome.
Yep, that's the grant. And it's actually treated, it used to be considered a grant. Now they're classifying it, it's technically a second mortgage or second lien on the property, but that will go away. It's forgiven, I believe, after 4 or 5 years. I'll have to double check that. But it is forgiven after that particular amount of time. But if you were to sell or refinance your home within that window, you'd have to pay it back. But most people don't. Most people will always stay there until, you know, that windows pass, and then they can do, you know, do what they want after that. But it's nice because it gets you into your house, and that's the most important thing.
Yeah.
And it's not a bad deal. It's a great agency that we have to help, especially with first-time home buyers. Yeah.
Right. This was great information. Thank you so much, Corey. We'd like to open this up for Q&A though. Does anyone have any other questions that we may have missed? Feel free to type in the chat box or comment section on Facebook. And Marie, let us know if we have any questions coming in.
Sure. Yeah. So while we wait for some of those questions to come in, we want to thank you, Corey, again, for coming on with us and
Absolutely,
answering
anytime.
all these questions. We were kind of grilling you, so thank you so much.
Yeah, you're
and
welcome.
thank you. Yeah, thank you for anyone who joined us today as well. Or if you're watching the replay, thank you so much. And don't forget, this is going to be a video series every week. So come and join us back in the heat in the summertime. We'll be sweating with you, talking about real estate and answering any questions that you may have. Next week, me and Fatima are going to be going all through searching and touring, so don't miss that. And if any of you have additional questions that maybe you forgot and you know you're thinking of it now after the Zoom or after the live, please reach out to any 3 of us and we'd love to talk to you. So Corey, could you tell everyone your contact information? What's the best way to reach you?
Yeah, so you can reach me on my office phone, which is 603-472-2220. They can call my cell, 603-540-2198. Or you can send me an email, which is C Bowman, that's B as in boy, OWMAN @HarborOne.com.
Awesome. Thank you.
Yeah, thank you.
We'll tag all of us in the post, so you can reach out to any one of us whenever, easily.
Yep.
Through Facebook and find our info on there.
Yep.
Awesome.
So thank you.
Thank you so much. Do we have any other questions, or are we good?
Not that I saw. I think we were pretty thorough.
Yeah,
Well, don't hesitate to reach out to us with any of these questions, and I'll be more than happy to help anybody out. So.
All right. Thank you so much, and we'll see you next week.
All right.
Have a great day, everyone.
All right. Thanks, guys.
Thank you.